Welcome back to our series on revenue recognition. Today, we're diving into something that happens all the time. A deal changes right in the middle of things.
So, let's just jump right in. Picture this. You've got a contract, work is humming along, and then the client calls. They want to add more, maybe change the price. The big question is, how do you account for that? Is it a whole new deal or just a little tweak to the old one? Well, it's not a guess. There's a very clear process to follow.
In accounting speak, this is what we call a contract modification. It's basically any approved change to what you're delivering, the scope, or what you're getting paid, the price. And trust me, getting the accounting right from here on out is absolutely crucial. It all kicks off with one simple question.
This is the first major fork in the road. We have to figure out if this change is so big that it's basically its own brand new contract, or if it's really just an edit of the original. And to figure that out, there's a really specific test you've got to run.
Here it is, the two-part test. Now, for a change to be treated as a completely new contract, both of these conditions have to be met. No exceptions. First, the deal has to expand with goods or services that are distinct. That just means the customer could have bought them on their own. And second, the price for those new items has to reflect their normal standalone selling price. If you can check both of those boxes, well, then your life is pretty easy.
That puts us on what we'll call Path A. This is the simple route. When the change qualifies as a separate contract, you pretty much draw a line in the sand. You keep accounting for the original deal as is, and you start fresh with a new one.
Let's look at a quick example of how cleanly this works. Imagine your original deal was for 120 units. Then, the client adds an order for 30 more. Now, because those 30 units are distinct, you could sell them separately, and their price of 950 rupees is their current standalone price, it passes our two-part test. So what do? You just continue business as usual for the first 120 units, and you start a completely new contract for those extra 30. Super clean, super simple.
But of course, what happens if those two conditions aren't met? Maybe the new items aren't distinct, or the price is some weird bundled number. Well, that's when things get a little more interesting. It takes us down Path B, where the change is considered part of the original contract.
So once we know we're on Path B, we have a second huge question to answer. You have to look at everything you still have to deliver and ask, are these remaining items distinct from what the customer already has? The answer to this question is going to tell you exactly which accounting method to use next.
And this lays out our two options perfectly. If the remaining items are distinct, you use the prospective approach. Think of it like this. You basically cancel the old contract and create a brand new one for everything that's left. But, and this is a big but, if the remaining goods are not distinct, maybe because they're all part of one big integrated project, then you have to use the cumulative catch-up approach. This means you're actually going back and adjusting the revenue on that single original performance obligation.
Let's really drill down on that cumulative catch-up approach. You'll see this all the time with big, complex projects like construction or a major IT implementation. Basically, anything where you can't just separate one piece of the work from another. This is a perfect example. A company has a 200-hour infrastructure project. They're 100 hours in, and the client adds 50 more hours, but at a lower rate. The key here is that every single hour of work is contributing to the same finished project. You can't separate hour 101 from hour 99. They're all part of one non-distinct service. Because of that, you can't just start a new contract. You have to go back and recalculate the total revenue for the entire single project, making a catch-up adjustment on the day of the modification.
So when you strip it all down, it's not random at all. It's a very logical decision tree. First you ask, is this a new separate contract? If the answer is no, you move to the second question.
Are the remaining parts of the deal distinct? Your answers to just these two questions will point you to the one and only correct way to account for the change.
Now that's done, before you go to the next part, please refer to your textbook thoroughly. It's very important for exams, and write down some notes to make your revisions quicker. See you in the next part.